And let's start by examining what's happening with COMEX registered silver. Registered silver, the metal fully backed and available for physical delivery against futures contracts, remained steady at 88.19 million ounces going into the weekend. There was no inflow of new metal. The February contract is essentially complete. What stands out isn't just the lack of outflow, it's the absence of fresh metal replacing what has already left. Eligible silver, the broader category stored in vaults but not immediately deliverable, continued to decline, dropping another 1.2 million ounces in a single session. Overall, COMEX inventories are experiencing net outflows, even while registered silver remains flat. Structurally, this is important. The March contract still has open interest around 222 million ounces, while registered silver sits at 88 million ounces. This points to a deficit exceeding 130 million ounces between what is deliverable and what is theoretically owed. The roll from March to May is moving too slowly, with only 15 million ounces rolling in a single day. With just 4 trading days left before March enters settlement, the numbers simply don't add up. For anyone monitoring this, the structural problem is clear. COMEX inventory reports, which are publicly available and updated daily, show the urgency. Those tracking the roll pace understand why it's critical. Here's where it gets interesting and where mainstream analysis misses the point. China was offline all week for the Lunar New Year, a major driver of physical demand essentially absent from the market. Conventional wisdom would suggest metals struggle without Chinese activity. Yet silver surged nearly 9% by Friday's close, hitting $84.57 on the futures, while gold reclaimed $5,100. These gains occurred without China participating. Pause on that for a moment. The pressing question now, what happens when Shanghai reopens on Tuesday? Data gives us a clearer answer than forecasts. Shenzhen's largest silver recycling company, one of China's key precious metals trading hubs, was offering $93 per ounce to buy back $99.99 pure silver over the weekend. That's the physical bid inside China while exchanges remain closed. For context, Western futures are trading at $84, while Shanghai spot was already at 86 cents. Once the Shanghai Gold Exchange reopens, the premium gap in physical demand will become immediately evident. Those tracking these spreads understand what a $93 physical bid from a major recycler signals once exchange prices adjust. This links directly to a point I've made for months: the ongoing disconnect between physical and paper markets. Data from the Silver Institute and structural supply reports confirm we are in the 6th consecutive year of a structural silver deficit. Global mine production is about 800 million ounces annually, and projections for 2026 show a shortfall nearing 300 million ounces, over a third of total annual production. This is not trivial. It's a structural imbalance that paper markets have masked for years through forwards, leases, and rehypothecation. Beneath this lies another story, what has been unfolding between JP Morgan, China, and the silver market over recent months. China has consistently bought silver on dips, conditioned by years of suppressed prices to treat every pullback as a buying opportunity. This behavior created a reliance on low-cost silver, leaving Chinese industrials structurally short when market dynamics shifted. When JP Morgan removed 13 million ounces from COMEX registered inventory and reclassified it as eligible, effectively removing it from the deliverable pool, a Chinese industrial firm attempting to hedge its short position on COMEX and take delivery was told directly that the silver was unavailable. This triggered a short squeeze, with Chinese markets hitting limit up as short covering orders overwhelmed the market. According to verified refining and market sources, JP Morgan spent the following weeks fulfilling that order by sourcing silver concentrate from Latin America, while Chinese buyers trying to acquire the same material were told it was already contracted. One Latin American producer confirmed that Chinese buyers offered $80 an ounce, $10 above market prices, because JP Morgan had secured the supply. Vince Lancency, publisher of the Goldfix newsletter, has documented this sequence in detail. His perspective is crucial. This is not just a story about silver, it is a proxy battle. JP Morgan acted on behalf of Federal Reserve interests, while the PBOC operated through its own market representatives. Silver became the visible battlefield for this conflict. The structure of the Chinese market exacerbated the situation. An open-end fund in China was trading at 30% above its net asset value due to retail and speculative buying. When industrialists needing lower prices pushed regulators, the fund was placed in liquidation mode while silver prices remained high. This should sound familiar. The Hunt brothers experienced similar forced liquidations, but unlike that episode, the market did not collapse. Physical demand outweighed the regulatory intervention, preventing the market from being crushed. It is also important to consider the counterpoints. A stronger dollar can create headwinds for dollar-denominated metals. The yuan reaching its strongest level against the dollar since May 2023 is significant, as a strong yuan reduces hedging incentives for Chinese buyers and can slightly lower import premiums. Silver's jump from $79 to $84 in a single session last week also created short-term traders who may take profits before any continuation. Additionally, some supply-demand projections, including large deficit estimates, are institutional forecasts, not actual outcomes. Supply responses can change the trajectory, and these are real variables anyone managing capital must account for. However, data shows trends that forecasts don't fully capture. The LBMA, the central hub for global silver lending, effectively ran out of above-ground available stock. Lease rates spiked when the interdealer lending network seized, forcing banks to publicly borrow silver. This was a documented market event, not a forecast. When the informal lending cushion disappears, physical reality imposes itself. As Howard Marks notes in Mastering the Market cycles are driven not only by fundamentals, but also by the point at which credit and liquidity structures confront physical reality. The LBMA lease rate spike reflected precisely that moment. Returning to recent events, Shanghai has reopened, with physical bids in China running $9 above Western futures. The COMEX March contract is moving slowly, with 4 trading days remaining. Registered silver remains unchanged, and no new metal has entered the deliverable pool. Gold is above $5,100 with China offline, and the yuan has strengthened to levels not seen since May 2023, signaling capital flows and pressure on dollar-denominated reserve systems. When silver dropped into the $72 range, sentiment flipped sharply bearish. Capitulation was widespread. I highlighted a structural support zone between $70 and $70.60, a bullish swing failure pattern, and a potential inverse head and shoulders formation, all overlooked when sentiment was negative. Now silver is at $84.60, demonstrating the importance of analyzing market structure rather than headlines. This is not a claim that silver will immediately reach all-time highs. The key point is observing how sentiment reacts. A 5 to 10% drop triggered extreme bearishness, and a 5 to 10% recovery flipped sentiment bullish again. The same traders repeatedly reverse positions. If your decisions rely on these swings, you are reacting to sentiment, not reading the market. It is the market shaping perceptions, not fundamentals. And there is a reason sentiment consistently behaves this way during such moments. The 1974 U.S. Embassy cable, a declassified government document, not speculation or theory, explicitly explained how a large gold futures market could make physical trading seem insignificant, increase volatility, reduce demand for physical metal, and discourage long-term holding by citizens. They understood market psychology decades ago. Flood the market with paper, amplify the dips, and let sentiment do the suppression. There's no need to force sales, scare participants enough, and they will sell themselves. When silver reached $72, sentiment acted exactly as intended. Most people sold based on the narrative rather than analyzing the actual market data. The market structure never lies, the headlines do. Many arrive skeptical, and that's fine. But when they see an unbiased, raw view without fear-mongering hype or agenda, they recognize the truth. Some initially thought this was propaganda, yet they stayed because once you see the signal clearly, there's no going back to noise. I do not sell anything, never have, never will. I simply show up and share what I know. The tools, concepts, and frameworks I provide are unique. You won't find them packaged or diluted anywhere else. All I ask is that you bring a genuine desire to learn. That's enough. With commitment in 6 to 12 months, your understanding will reach an entirely new level, not because of me, but because of your effort. My goal is simple: to make you precise, independent, and capable of making decisions without relying on anyone, headlines, the crowd, or even me. The aim is for you to become the apex predator, the top of the chain. That's always been the objective. Looking ahead to Tuesday, Shanghai reopens with a physical bid inside China, trading $9 above Western futures. COMEX registered silver has not seen new metal enter the deliverable pool, and the March roll is dangerously behind with limited time left. Gold remained above $5,000, even with China absent from the market. Consider what that says about demand. The silver market, originally designed to operate under $30 per ounce, is now functioning at nearly 3 times that level, with strong physical demand that isn't fading. The critical question is whether the COMEX March settlement will trigger genuine delivery demand that cannot be absorbed by current registered inventory. With 222 million ounces of open interest versus 88 million ounces of registered silver, the math does not resolve quietly. Watch the roll pace on Monday and the registered figures Tuesday morning.